In this video, we'll talk about the basics of real estate investment trust, which is commonly known as REITs. We are very sure that you will be very interested in REITs investment. This is because we may not be able to own a physical property, but we are still able to indirectly own some real estates, which potentially will give us consistent returns. We'll walk you through the introductions of REITs, how do REITs work, how do REITs earn return, as well as understanding on tax for REITs. Introductions on REITs. Real Estate Investment Trust. REITs is a company that makes investment in income-producing real estates. Investors who would want to have a view on property investments, but having a constraint of owning a property. REITs is one of the ways for us to access real estates. In turn, buy shares of a REIT and will be owning a portfolio where the investors get to expose to all of the properties owned by the REITs. REITs are required to derive at least 75% of their gross income from real estate related sources and invest at least 75% of their total assets in real estates. REITs are also required to distribute at least 90% of income earned from real estate investments to the investors by law. Real estate has two ways of generating the long-term returns, which are capital appreciations as well as regular use through dividends. Now, let's talk about how do REITs work. The REITs pool the capitalizations to make investment in different kinds of real estate investments. Investments can include the REIT's direct ownerships of real estates, real estate loans, or even hybrid. We can classify REITs in three different ways: equity or debt, such as mortgage REITs, exchange-traded REITs, sector-focused REITs. For equity, it has high growth potential and also a very strong potential for income generations. For debt, it has strong potential for income generations and potentially a fixed return. For exchange-traded REITs, it is regulated by SEC, Securities Exchange Commissions. Sector focus. For sector focus, they are generally focusing on different sectors like hotels, office building, etc. Here comes the interesting parts, which is how do REITs earn returns? REITs earn returns through income and capital appreciations. In equity investments, income is generated from rental by the tenants on a regular basis, such as individual pay for living spaces, businesses paying for retail space, as well as big organization pays for office space. In debt investment, income is earned through the interest paid by the loan payer, which is typically a consistent timeline. Capital appreciations. When the REITs own a property directly, any increases in the value of property, the value of the individual share of the REITs may appreciate, and conversely, the share values will depreciate if the properties lose value. Next, how do the REITs investors realize returns? Since the REITs earn the return through the appreciations of property value, similarly, REITs investors generally can realize the same type of returns. For income-generating investments, REITs investors typically realize returns through dividends distributions, which is also earned by individual real estate properties. Dividend is paid based on the share ownership of an individual. REITs do attract a lot of investors. This is because investors have the potential to earn from capital appreciations and income in general. Real estate is a hard asset. When the demand outstrips the supply in the market, the underlying value of a property and the rental income may potentially increase together. Lastly, let's understand further on the tax for REITs. REITs in general will distribute at least 90% of the taxable income to the REITs investors every year through dividend distributions. REITs investors are required to pay tax at the individual level. We have come to the end of this video. We are sure that you have gained some basic understanding about REITs and how REITs earn you consistent returns. It's always best to allocate some of our money into real estates, as it is a hard asset and it will potentially give us a very lucrative return in the long run. There's always a saying in investment: do not put all the eggs in one basket. We would need to diversify our portfolio so that we can achieve an optimal return on our investment.